Let's now turn to the advisory. The government is pushing ahead with revised Division 296 despite widespread industry criticism during consultation, raising questions about the value of stakeholder submissions. Let's get across it all. Liam Shorte joining us from SONAS Wealth. Liam, welcome back. Of course, this is over those changes to Super 296. So I can see you're not pleased. You say the government asked for submissions and then subsequently seemed to ignore them.
Yeah, they asked for submissions on the 19th of December, closing it off for the 16th of June or 16th of January, and then ignored all the submissions that came through to them. So all the issues that were raised, especially around things like the new Division 296 legislation is going to calculate the Division 296 based on the higher of someone's TSB balance, total super balance, at the start of the year and at the end of the year, after the first year. And this will affect people, for example, if someone dies during the year, because they would have had a balance at the start of the year, now they're going to be hit by Division 296 in their estate once they die. So a complication like this for blended families especially, we have clients where the super is being left to the children from the first marriage, and the rest of the assets are being left to the second spouse. But this Division 296 is a personal tax. So what may happen is the SMSF or the super may be paid out to the children, but then the estate gets a tax bill in the individual's name for the earnings on that super before they died. So there's things like this which just have been totally ignored, and there's problems with the CGT calculations and the way that they're focusing on those. They just haven't listened. So again, it's going to be a case of we're going to rely on the crossbenchers to try and call some of these things to account when the legislation is being, as it is now, being pushed through Parliament.
Yeah, so still on track to be imposed July 1 this year. I mean, we did get some concessions there, but you're saying they just haven't gone far enough.
Yeah, they basically, it's the devil in the detail, Andrew. It's just that they're blasting this out without looking at how it's going to be implemented and the effects it will have on things like assets within a super fund that are held through other entities like unit trusts or companies. So there's just a lot of detail that just needs to be figured out and discussed and possibly just come back to reality of how easy or hard what they want to put into place is actually going to be.
Liam, let's turn to investing as far as an SMSF trustee is concerned, where you put your money. Now, some may be in crypto. Goodness, haven't we seen some losses there? But you're saying perhaps, particularly your auditor needs to look out there of what you're actually, what you're actually holding.
Yeah, look, it's more a fact that be prepared for your auditor to be asking for a lot more than they have previously. Previously, they were happy with a statement from the investment from the crypto exchange and maybe a screenshot of your holdings on the 30th of June. But now they're being asked to actually look for proof that those holdings do actually physically exist. And I know some of the conservative auditors are asking for a report called a GS007. This is, it puts a lot of requirements on the investment exchange, and at the moment all those crypto investment chains are busy getting prepared for licenses, so they're not doing the background that's needed for these reports that the auditors are looking for. So be prepared for delays in submitting your SMSF financials, for just constant harassing from the auditor looking for what they need to actually pass the audit. Maybe some common sense may need to be come to the fore over the next couple of years.
Liam, you say your super's not for gambling. Well, some may argue that if you're in crypto, that is certainly gambling. Nonetheless, you do have a salutary lesson as to why you shouldn't put all your eggs in one basket.
Yeah, and it's often people who don't really understand what they're investing in, and they look to get on the bandwagon when it's a little bit too late. So there's something going around the advisor community at the moment with I think it was a TikTok or Twitter post where somebody said, I've sold down all my pension assets, I've sold down all my assets that I have outside of super, and I've invested it all in silver. I've gone full on silver, and then just the graph showed the next day an 18% drop in silver. So it's a case of, your super's there for your retirement, for the long term. Don't put all your eggs in one basket. Take everything with a pinch of salt, and especially be careful if something's already had a huge run up. be very careful about jumping on a bandwagon too late.
And you also made the point to beware of illiquid investments. I guess that would particularly apply, you point out those thematic ETFs, which are very attractive.
Yeah, and so like a lot of the smaller ETF providers are bringing out these thematic ETFs that people do like them, or they're bringing out something that mirrors one of the existing bigger ones, like the income, the high dividend yield ones. But what's happening is they're putting a large amount of money into an ETF that is not big enough yet to handle the liquidity needs if they need to get out. So for example, you might have an ETF that's got 70 million in it, and a client might put 400,000, so they end up with only over 0.5% of the ETF, and they don't realize that ETF is only trading about 70,000 units a day. So if they want to sell their 200,000 or 400,000, might take 5 days or a week to get out of it, and they're also pushing the price down all that time, so they're taking a bath on the actual exit price that they get. So if you're looking at a thematic ETF, look at the size of it, look at its daily volume, and assess how much you want to put into there based on, are you willing to take that risk, and are you willing to look at the liquidity risk on exiting if you need to exit.
Now, Liam, property is often one of the cornerstones of an SMSF portfolio, but you warn investors potentially that if you're getting into commercial property, beware if you're trying to set up a new business venture. What are your concerns?
Yeah, so this is the question of the week that we got on our SMSF coaching forum. And basically somebody came on and said, look, I'm thinking of a new venture, and I'm wondering, should I just use my super to buy commercial property to run that venture out of? And the overwhelming answer from auditors, accountants, financial planners was, no, you don't put everything at risk at the one time, especially on a new venture. Commercial property in an SMSF is a great investment, but great if you're expanding your business is going through a period of growth, and you're looking for that ability to build a business without using the capital that you have in the business itself. The SMSF can own your property, but if you're starting out a new venture, you've got to remember that the SMSF leasing that business premises back to you, they must do it on commercial terms. So if the business starts failing, you as trustee of your super fund could be legally obliged to chase you as the tenant for payment of those of that rent money. And the problem is, we know people's general nature. They will say, oh well, look, I'll just give the business a little bit of leeway, we'll leave it a couple of months, they'll catch up, the business will improve. By the time it comes to the ATO's attention, they're 1 or 2 years behind on the rent. What you put yourself in that stage is where the auditor puts in a contravention report, and the effects then is your fund can become uncompliant, and you may have to sell the property. But also you as director of your fund's trustee may also be penalised by the ATO and stopped being a director of any future company because of your failure and your contravention. So you could mess up your whole future just by taking a gamble at the wrong time and using the wrong strategy. So if you're starting up a venture, it's not the time to commit your super fund to it. Wait until you've got it established and you're looking for a growth period. That's when something like a commercial or industrial property in a super fund can really help a business going forward.